daily brief for Wednesday, April the 2nd, 2025.
Right.
Markets just closed, 3:15 in the afternoon, Indian Standard Time.
Yes.
Welcome to our 12th briefing.
12th one already.
I know, right? Time flies.
It really does.
We'll be taking a look at the numbers and everything that moved them today.
Of course. Yeah.
And a big one that's been on everyone's mind.
Definitely.
Those potential U.S. reciprocal tariffs.
Big question mark hanging over everything.
Exactly. So we'll try to get a sense of how the markets are reacting to all that.
Absolutely. Got to understand the sentiment out there.
But before we jump into all that,
Sure.
let's start with our financial fact of the day.
Always a good way to set the scene.
You know, it always helps to get a little perspective on things.
Absolutely. Puts things in context.
So did you know that something like 70% of households here in India
Wow.
invest in gold?
70%. That's a huge number.
Yeah, pretty staggering, isn't it?
It really is. Really makes you think about how we view investments here.
It really does, even with all these fancy market instruments we talked about.
Right.
Gold still holds a special place.
Absolutely. It's not just about returns either.
No.
It's like a safety net for a lot of people.
Yeah.
A way to pass on wealth across generations.
A tradition, almost.
Very much so.
Interesting to think about as we look at today's market performance.
Indeed. Let's see how those numbers shaped up.
All right, diving into our market summary then.
Grab it.
The Nifty 50 closed at 23,329.30.
Not bad.
Up 163.60 points.
A decent game.
That's a 0.71% increase.
Healthy climb.
Nifty Midcap 150 ended at 19,200.75.
Oh, even better.
Up by a significant 269.35 points.
Wow, they outperformed the Nifty 50.
They did. 1.42% rise for them.
Small caps, too.
Yeah. Nifty Small Cap 250 closed at 15,179.75. A gain of 149.65 points.
Not too shabby.
1% rise for the small caps.
So a good day for the broader market then.
Definitely. The Nifty Total Market Index closed at 11,951.25. Up 108.4 V points.
Right.
0.92% increase.
So, yeah, lots of green on the screens today.
Pretty much, yeah.
Good to see some positive momentum.
Now let's shift gears a bit.
Sure.
Look at the bond and currency markets.
Always important to get the full picture.
The 10-year Indian government bond yield.
Yeah.
It's currently at 6.5823%.
Okay.
Actually down slightly from last week.
Oh, is that so?
Yeah, 4 basis points lower.
Interesting.
And if we check out the NRUSD exchange rate, it's trading at 85.6497.
Okay.
That means the rupee's weakened a bit against the dollar.
A little bit of depreciation there.
Right, and it makes you wonder how much of this is tied to the big news of the day.
You mean the tariffs?
Exactly, the potential U.S. tariffs. Can't ignore those.
No, absolutely not. They're definitely on everyone's radar.
So we've seen reports that the rupee softened to around 85.60 against the dollar today.
Okay.
And this seems to be happening as these tariff expectations are building up.
Right, makes sense.
The rupee was stronger earlier in the year.
Quite a pullback then.
It is, and it shows that the markets are reacting to these developments.
Definitely. Currency markets are usually the first to show jitters.
Yeah, they're quite sensitive to perceived risks.
Exactly. And the tariffs, well, they could disrupt trade flows.
Absolutely, and that can directly impact export earnings.
Right, all of that gets factored into a currency's value.
And speaking of reactions, the FIIs, the foreign institutional investors.
Yeah, what about them?
They've been pulling out funds.
Oh, really?
Reports say they've withdrawn about 10,000 crore from Indian equities.
Whoa, 10,000 crore. That's a serious amount.
It is, and this is all happening before any concrete tariff announcements.
So they're not taking any chances.
Seems like it. They're being cautious.
Understandable, given the potential impact.
So even though the market's closed in the green today,
Right.
there's definitely some underlying anxiety.
Yeah, you can sense it.
Especially in sectors that rely heavily on U.S. exports.
Makes sense. They're the ones on the front lines.
So which sectors are we talking about specifically?
Well, from what I've been seeing, the talk is that pharmaceuticals, IT, and agriculture could be the most vulnerable.
Right. They all have a big stake in the U.S. market.
Exactly. For example, Indian pharmaceutical companies. A lot of the revenue comes from the U.S., especially for certain drugs.
Okay.
And the IT sector, their services are a major export to the U.S. too.
So any tariffs could directly hurt their profits.
Absolutely. And potentially affect their future growth.
It's like a domino effect.
It is. One thing leads to another.
And it's not just the equity markets that are reacting.
Really? What else is happening?
Even the bond market is showing some movement.
Interesting. How so?
Analysts are predicting that the 10-year bond yield will stay within a narrow range this week,
Okay.
somewhere between 6.52% and 6.60%.
All right.
But there's talk of a possible dip within that range.
And that's linked to the U.S. tariffs, too.
Seems to be the thinking, yes.
How so?
Well, the expectation is that the tariffs could slow down the U.S. economy, and that could then have an impact on bond yields globally.
Makes sense. It's all connected.
So we've got all this uncertainty surrounding these tariffs.
It's the big unknown right now.
And I'm sure a lot of investors are wondering how to approach the markets.
Yeah, what's the best strategy in a situation like this?
Well, from what I've gathered,
Uh-huh.
prudence seems to be the key word.
Okay, so caution is advised.
Yes. Analysts are recommending a focus on companies with strong fundamentals.
Makes sense. Those are usually the ones that weather storms better.
Right, especially when there's global economic uncertainty.
Solid balance sheets, consistent performance,
That's what you want to look for.
and maybe some defensive sectors, too.
Yeah, those tend to be less affected by economic swings.
Like consumer staples.
Right, healthcare, utilities.
The essentials, the things people always need.
Exactly. So overall, a more cautious and selective approach seems to be the way to go.
Makes sense as we wait to see how things unfold with these tariffs.
So looking at the broader picture then, it's clear we're in a wait-and-see mode.
Yeah, waiting for the other shoe to drop.
We need more clarity on the tariffs.
The specifics, the timing, all of that.
Exactly, and how they'll reshape global trade.
It's a complex situation.
It is. We have to balance the strengths of the Indian economy with these external uncertainties.
Right. The global factors we can't control.
Now, if we zoom out even
To
further,
the macroeconomic level.
yes, the potential impact of these tariffs could be significant.
It could touch a lot of different areas.
And while we don't have all the details yet,
Right. We're still waiting for the fine print.
we can assume that sectors heavily reliant on U.S. exports,
Yeah,
they could face challenges.
definitely. Those direct trade links could become a problem.
On the other hand,
Yeah.
industries focused on domestic consumption within India,
Right.
they might be somewhat shielded.
Makes sense. Less exposure to international trade pressures.
And the RBI, the Reserve Bank of India,
Uh-huh.
they'll have a crucial role to play in all this.
Absolutely. They'll need to navigate these external pressures.
Might need to step in to manage currency fluctuations,
Right. And maybe adjust monetary policy, too.
all to maintain economic stability.
It's a delicate balancing act.
And if we look specifically at the equity markets,
Okay.
we've seen the FIIs pulling out funds.
Yeah, they're getting out of the way.
But our domestic institutional investors, they've been more supportive.
Oh, that's interesting.
So there's still some confidence from within India.
So it seems good to see that resilience.
The advice for investors now seems to be focusing on strong companies,
Right. Companies with a solid track record.
diversified revenue streams,
So they're not overly reliant on one market.
and of course, thorough due diligence.
Absolutely. Understanding the businesses you're invested in.
Now, over in the fixed income markets,
Uh-huh.
bond yields have been relatively stable,
Okay.
which might indicate some confidence in the RBI's ability to manage the situation.
Yeah. Faith in the central bank.
But for bond investors, it's still important to watch inflation trends,
Makes sense.
government fiscal policies,
Right. How the government is spending and managing its finances.
and global interest rates, of course.
All those factors can influence bond yields.
Definitely. Things to keep in mind.
And what about the currency markets?
Well, the rupee's depreciation.
To that 85.64 level against the dollar?
It just shows how sensitive it is to these global trade concerns.
Right. Any tension and the rupee feels it.
And while it's been strong at times,
Mm-hmm.
these international tensions can definitely push it down.
So what does that mean for businesses?
Well, for importers,
Yeah,
a weaker rupee makes their imports more expensive.
right. They'll need to find ways to manage that.
Hedging strategies might be a good idea.
To protect themselves from further depreciation.
But for exporters,
Mm-hmm.
a weaker rupee can actually be beneficial.
Oh, how so?
It makes their goods and services more competitive internationally.
So there are two sides to the coin.
Exactly. Winners and losers, depending on which side of the trade you're on.
It all comes back to risk management.
Definitely. Being aware of these fluctuations is crucial.
And adapting accordingly.
So, as we wrap up,
Okay.
let's look at some potential investment themes.
Where should people be looking?
Well, given the current environment,
Yeah.
defensive sectors seem like a good bet.
Like we talked about earlier.
Consumer staples, healthcare, utilities,
They tend to hold up well in uncertain times.
and domestic consumption in India.
Right. The internal growth story.
That's still a strong theme.
A lot of potential there, driven by the growing middle class.
And there's the infrastructure and renewable energy space.
Yeah, the government's focus on that is clear.
Lots of long-term growth potential there.
And, of course, technology and innovation.
Always a dynamic sector.
Digital transformation, automation, all that.
So a mix of stability, internal growth, and long-term potential.
And through all of this,
Yeah.
don't forget about risk management.
Absolutely crucial. Diversification is key.
Spread your investments across different areas,
And stay informed.
both domestically and internationally.
And most importantly,
Yeah.
understand your own risk tolerance.
And have clear financial goals.
Consulting a financial advisor is always a good idea.
They can help you tailor a plan that suits your needs.
Right, before we go,
Sure.
let's quickly recap what we covered today.
The key takeaways.
So the anticipation of U.S. tariffs.
Right, that's been the main theme,
It's creating uncertainty across various sectors,
especially those with significant U.S. exports.
like pharmaceuticals, IT, and agriculture.
They're feeling the heat.
And we saw the FIIs pulling out 10,000 crore from Indian equities.
Sign of caution there.
The benchmark bond yield is expected to stay between 6.52% and 6.60%.
Reflecting the uncertainty in the market.
Now, from a broader market perspective,
The bigger picture.
we're in a complex environment.
Balancing internal strengths with external pressures.
The macroeconomic environment will be shaped by these trade developments.
And the RBI's response will be crucial.
In equity markets, the focus is on strong companies with diversified revenue.
Limited exposure to the U.S. market.
Fixed income investors need to watch inflation and global interest rates.
And in currency markets, the rupee's depreciation needs to be managed.
For investors, defensive sectors, domestic consumption, infrastructure, and technology.
Those are the themes to consider.
And remember, risk management is paramount.
Diversify, stay informed, and get advice if you need it.
So that's it for today's Finwell Daily Brief.
Another one down.
If you found this valuable,
And we hope you did.
hit that subscribe button.
Stay up to date on the markets.
We'd also love for you to connect with us on LinkedIn,
Yeah, join the conversation.
SOS. Well, you can find us there.
Share your thoughts, ask questions.
And don't forget to subscribe to the Finwell Daily Brief.
Get your daily dose of financial insights.
Now, to end our briefing today,
All right.
a quote from Charlie Munger.
The wise Charlie Munger.
He said, "The big money is not in the buying and selling, but in the waiting."
Powerful words.
A reminder to think long-term.
Patience is key in investing.
And just a reminder that the information we shared today,
Yeah,
it's for informational purposes only.
not financial advice.
Do your own research or consult a financial advisor.
Before making any decisions.
Thanks for joining us today.
Until next time.